지금부터 Iasb 공개초안 위험경감회계 세미나를 시작하겠습니다. 안녕하십니까? 저는 오늘 세미나 사회를 맡은 회계기준원 김재호 회계기준 실장입니다. 먼저 바쁘신 와중에 오늘 세미나에 참여해 주신 여러분들께 깊이 감사드립니다. Iasb는 현행 위험회피 회계기준이 개방형 포트폴리오 관점을 반영하지 못하는 점을 보완하고 순액 기준으로 이자율 위험을 관리하고 있는 기업의 위험관리 활동을 재무제표에 보다 충실하게 반영할 수 있도록 새로운 위험회피 회계 모형인 위험경감회계 공개초안을 작년 12월에 발표하였습니다. 이번 Iasb 위원 초청 세미나에서는 위험경감회계 공개초안을 담당하는 Iasb 위원과 실무 담당자가 공개초안의 주요 내용과 재정 배경을 직접 설명하고 국내 이해관계자와 Iasb 간 긴밀하게 소통할 수 있는 기회를 갖고자 합니다. 현행 위험회피 회계 기준과 달리 순액 기준의 개방형 포트폴리오를 전제로 하는 위험경감회계는 전통적인 위험회피 회계 기준과는 다른 접근법이기 때문에 공개초안의 취지와 실무에 미치는 영향에 대해서 충분히 이해할 필요가 있습니다. 아무쪼록 허심탄회하고 건설적인 의견이 널리 공유될 수 있기를 기대합니다. 이번 세미나는 더 많은 분들께서 세미나에 참여하실 수 있도록 온라인과 오프라인을 병행하여 진행합니다. 오늘 세미나는 온라인으로 송출되며 녹화 영상은 회계기준원 홈페이지 및 유튜브에 게시될 예정임을 알려드립니다. 그리고 이 세미나는 현재 동시 통역되고 있습니다. 현장에 계시는 참석자들께서는 리시버 채널 1을 선택하시면 한국어 통역을 들으실 수 있습니다. 온라인으로 참여하시는 분들께는 3가지 안내 말씀드리겠습니다. 첫 번째로 오늘 세미나 자료는 여러분들이 지금 보시는 화면 아래쪽에 다운로드 안내 문구를 클릭하시면 내려받으실 수 있습니다. 장내에 계시는 분들께서는 행사 현장에서 QR코드를 통해서 자료를 내려받아 참여해 주시면 감사하겠습니다. 둘째로 이 세미나가 진행되는 동안에 Q&A 게시판에 질의를 올려주시면 주제 발표가 마무리되는 대로 답변해 드리도록 하겠습니다. 주저하지 마시고 적극적으로 참여해 주시기 바랍니다. 장내에 계신 분들께서는 안내 데스크에 준비된 질의 양식의 질의를 적으셔서 저희 스태프들에게 전달해 주시기 바랍니다. 마지막으로 공인회계사 연수 인정을 받고자 하시는 분은 세미나가 끝나는 대로 반드시 로그아웃 해 주시기 바랍니다. 보고 계시는 화면 오른쪽 윗부분에 있는 웹이나 나가기라는 버튼을 클릭하시면 됩니다. 로그인 정보뿐만 아니라 로그아웃 정보가 모두 있어야 연수 시간으로 인정받을 수 있다는 점 특히 유의해 주시기 바랍니다. 본격적인 주제 발표와 Q&A에 앞서서 먼저 회계기준원 곽병진 원장님이 여러분들께 드리는 인사 말씀이 있겠습니다. 원장님 연단으로 이동해 주시기 바랍니다. 여러분 큰 박수로 청해 주시면 감사하겠습니다.
방금 소개받은 회계기준원장 곽병진입니다. 존경하는 Iasb 위원 여러분, 그리고 이 자리에 함께해 주신 국내 금융계와 학계, 그리고 회계법인의 전문가 여러분 반갑습니다. 한국회계기준원장으로서 국제회계기준의 산실인 Iasb 위원분들을 이곳 서울에서 모시게 되어 매우 뜻깊게 생각합니다. 특히 제 취임 이후 Iasb와 함께하는 첫 공식 아웃리치 행사를 이처럼 중대한 주제로 시작하게 되어 감회가 남다릅니다. 먼저 글로벌 회계 투명성과 비교 가능성 제고를 위해 헌신하고 계신 Iasb 위원분들의 노고에 경의를 표합니다. 이해관계자와 끊임없는 소통을 통해 기준서를 진화시켜 나가는 Iasb의 아웃리치 활동은 회계 이론이 역동적인 실무 현장과 호흡하게 만드는 가장 핵심적인 과정이라 확신합니다. 오늘 우리가 논의할 위험경감회계 공개초안 역시 그 소중한 과정 중에 하나라고 생각합니다. 기존의 전통적인 위험회피 회계는 개별 항목 중심의 경직된 구조로 인해 기업이 전사적 차원에서 수행하는 순액기준 재조정 위험 관리를 반영하는 데 한계가 있었습니다. 이러한 측면에서 이번 RMA 모형은 동태적 위험 관리의 경제적 실질을 재무보고 체계로 내포하여 정보 비대칭 문제를 해소하는 진일보한 시도라고 평가합니다. 실제 위험관리 관행을 회계 기준에 투영하여 그 간극을 좁히고자 노력하신 Iasb의 접근 방식에 깊은 감사를 드립니다. 다만 우리는 여기서 한 걸음 더 나아가 실제 적용상의 정교함을 고민해야 합니다. 국내 금융기관들과의 사전 협의 과정에서 확인한 바에 따르면 제안된 RMA 모형이 한국의 독특한 비즈니스 환경과 완벽하게 일치하지 않는 지점들이 존재합니다. 한국의 은행과 보험사들은 자산부채 종합관리 체계와 순이자 마진 중심의 전략, 그리고 무엇보다 보험부채의 복잡한 금리 구조와 장기 현금 흐름 특성 등에서 고유한 리스크 프로파일을 보유하고 있습니다. 특히 보험산업의 경우 IFRS 17 도입 이후 보험부채의 측정 방식과 금리 민감도, OCI 선택권의 결합 등으로 인해 위험관리 메커니즘이 매우 다층적이고 정교해졌습니다. 따라서 RMA 모형이 이러한 복잡성을 충분히 수용하여 위험관리 활동의 실질을 왜곡 없이 반영할 수 있는지에 대해 보다 심도 있는 검토가 필요합니다. 여기서 우리는 본질적인 질문을 마주하게 됩니다. 회계 기준이 기업의 위험관리 관행을 단순히 반영하는 것인지, 아니면 회계 기준의 변화가 기업의 위험관리 전략 자체를 재편하게 만드는 것인지에 대한 문제입니다. 우리는 이미 IFRS 17 도입을 통해 회계의 변화가 자산운용과 리스크 전략에 강력한 영향을 미치는 경로를 경험해 왔습니다. RMA 역시 향후 한국 금융시장의 위험관리 패러다임을 바꿀 수 있는 중대한 변곡점이 될 것입니다. 그렇기에 오늘 이 자리는 단순히 공개초안의 내용을 공유하는 수준을 넘어 회계적 정당성과 실무적 수용성 사이의 최적의 균형점을 모색하는 생산적인 대화의 장이 되어야 합니다. 우리 한국 금융업계는 이번 공개초안에 대해 매우 구체적이고 전문적인 의견들을 준비해 왔습니다. 오늘 이 세미나와 향후 이어질 필드워크를 통해 이러한 목소리들이 Iasb의 최종 기준서 제정 과정에 건설적으로 반영되기를 기대합니다. 한국회계기준원 또한 이해관계자들의 전문적 식견을 결집하여 국제회계기준의 완결성을 높이는 데 최선을 다하겠습니다. 다시 한번 서울을 방문해 주신 Iasb 위원 여러분을 진심으로 환영하며 오늘 이 자리가 RMA 프로젝트의 성공적인 안착을 위한 유의미한 이정표가 되기를 기원합니다. 감사합니다.
네, 원장님 감사합니다. 이제 오늘 세미나의 주제 발표가 있겠습니다. 발표는 리카 스즈키 ISB 위원, 하기 캐런 ISB 위원, 그리고 지키니 ISB 연구원 세 분께서 진행해 주시겠습니다. 그럼 리카 위원께 마이크를 넘기도록 하겠습니다.
Good morning, everyone. Thank you very much for having us today. I'm Rika Suzuki, a member of the ISB. Today, I'm with my fellow board member, Hagit Karen, and also ISB's technical staff member, Zikini, who is leading risk mitigation accounting project. We truly appreciate your warm welcome. Especially, it's an honor for us to be here today because this is the first international event for a new chair Mr. Clark. We congratulate his new position as a president of KAI and also a new chair of CASB. We truly look forward to working together with you to develop high-quality international accounting standards going forward. You always have excellent team supporting you, and we truly enjoy working with your team all the way through this project as well as other projects. So we are so excited to seeing you today in Seoul. Thank you very much. And I truly appreciate KAI and CASB to host and organize today's educational session for us to provide an educational session on our new model, risk mitigation accounting. And at the same time, thank you very much for all the audience. I heard that you are still in one of the busiest seasons in Korean companies, and you must have time to make yourself available to join this session. But thank you very much for your passion and engagement with us. Thank you. I hope today's session will help you to give more understanding of our new model, risk mitigation accounting, and also enjoy this session. So for the first part of this session, I will give you a little bit high-level overview of this risk mitigation accounting model itself, and also this project together with Hagit. And then we will hand over to Ziki to explain the details about these models, including key features of this model and also how to apply this model in practice. So I hope the first part and second part together to help you get more understanding about this model. So let me start with the first part. So the question is why the Iasb started working on this project. It's been a while we started this project. Let me explain a little bit the history. So after the global financial crisis, the Iasb developed the IFRS 9 financial instrument and also IFRS 7 disclosures for financial instruments. So those standards helped the company to improve accounting for financial instruments significantly. But actually, at that time, we've already noticed that there is a big leftover for some financial institutions, which is about dynamic risk management or portfolio, open portfolio type accounting treatment, because many companies manage interest rate risk on a net basis by aggregating exposure to repricing risk across multiple open portfolios of financial instruments instead of managing the risk of each instrument or group of the same financial instrument individually. So what that means, for example, is I can give you a different flavor about this problem. So when you're thinking about you have the forest, you are the owner of the forest. That forest include different type of trees or different a group of different colors of trees. So our existing IFRS 9 only focus on the individual tree, not about a group of different trees. But actually, the owner, you, are managing all risks relating to the forest more holistically or looking at the risk of the entire forest, not looking at the individual trees. Unfortunately, our existing hedge model only focusing on the individual tree, not a group of different trees or entire forest holistically. So that is a problem because if our standard only targeting the one tree, not the entire forest, that means it's very difficult for the company to provide the information about the effect of how they mitigate risk to the entire forest, not just looking at the individual tree. So this it causes a huge problem because management want to explain. They want to explain about how they mitigate the risk identified throughout the forest, entire forest. But the IFRS 9 only provides a mechanism to looking into the one tree or a group of the same trees. So that is a distinction, create a distinction between how you manage the risk and how you account for the entire forest. So sometimes companies use proxy hedging, but that doesn't work in many cases. What is the outcome for this problem is that when management want to communicate their risk mitigation activities in the financial statement, but that information could not provide how they really manage the risk or the effect of risk mitigation itself within the financial statement. They have to use the information outside the financial statement instead. So they have to create additional investor communication materials, or sometimes they use a regulatory document as an alternative. And then that means the investors will have to look for the information somewhere outside the financial statement. So we really want to provide the solution for this problem to make the risk mitigation activity much closer to how management account for those activities. So that is the objective of this model. And in order to do so, we can also enable the company to provide effect of the entity's risk management activities within a financial statement when the entity manage repricing risk on a net basis. And we try to provide more enhanced information for users that enable a company to provide more information. So we enhance disclosure requirements within IFRS 7. So that is the objective of our model and why we started this project. So this is a bit of the history of this project. So as you know, we published our discussion paper on macro hedge in April 2014. Unfortunately, these proposals were unsuccessful, but because we could receive a lot of feedback from our stakeholders, what the problems and how we might be able to solve those problems. So we work on these feedback and identify and develop the new model to address those concerns. So after design the new core model, we made an additional engage with banks and prudential regulators and other stakeholders to define the model itself. And then we developed exposure draft risk mitigation accounting. And we published our exposure draft December 2025. So it's a really long journey for us to get here. So I hope 240 days comment letter period would be sufficient for you to think about new model. I understand that this model is quite new and quite different from the hedge model already exists in IFRS 9. So probably we thought we have to give a longer comment period for you to firstly learn this new model. And the next question is whether this model is workable in your environment, whether this model is workable for you or whether your model isn't workable for you. We really want to understand when this model works and when this model doesn't work and why. And if it doesn't work, we really want to understand why this model doesn't work. So I think during the longer comment period, we really want to receive your feedback about this model. So because of that, we decided to have field work. So we encourage you to participate in field work if you are interested in this new model. This is an opportunity for you to tell your story to us, why this works, why this doesn't. And I think a comment period will end of July this year, but we extended submission deadline for field work because we thought it's really important for you to take sufficient time to think about and test our model in your own environment. So that is the reason we extended. So I think I understand some participants of this educational session might have a lot of understanding about this model already, but there might be some other audience who are eager to learn this model from scratch. So if you are those who want to learn more about this model, we prepared some educational materials on our website. Probably after this educational session, the first thing I recommend you to check is a snapshot document. It includes summarized key information about our proposed requirements within the exposure draft and explain about our model. But at the same time, when you're reading through exposure draft requirement, illustrative examples and implementation guidance will help you to understand how this model is supposed to work in certain situation. So that also helps you to understand. And we already published actually 3 webcasts, not just 2. And third one, the presenter is Ziki Ni. So you can enjoy, once again, Ziki's presentation on webcast. So please listen and watch those webcasts to get a thorough understanding of our model. So I will hand over to Hagi to cover the rest of the overview of this project. Thank you.
Thank you, Rika. And hello, everyone. I'm very pleased to be here. So we're going to speak about the interaction of this risk mitigation accounting exposure draft with a post-implementation review of IFRS 9 hedge accounting. Just in general, post-implementation review is the research work that we do after we publish a standard, and we want to see whether it's working as we intended. So for IFRS 9, we look at the post-implementation review at different parts, and this part is about the hedge accounting. And hedge accounting in IFRS 9 requirements are applied by many stakeholders. We want to learn from them. And also the disclosure requirements in IFRS 7 are relevant to hedge accounting. We will also be looking at those as we will do our post-implementation review. So in general, when we do our post-implementation review, we reach out to our stakeholders with a request for information to ask them to what extent the standard or the requirements are working as intended. So the reason that we are doing this project or this process at the same time with risk mitigation accounting ED, the time overlaps, is because we see some synergies and efficiencies for us to work on at the same time. So for example, the idea of risk mitigation accounting is to provide a solution to a specific hole that we left in IFRS 9 for the macro hedge, portfolio hedge accounting. We want to see, first of all, whether risk mitigation accounting provides a good solution as it is, but also to what extent risk mitigation accounting really addressed the hole that we left in IFRS 9. Is there something that we missed? Are there risk mitigation accounting risk mitigation activities that we didn't cover well with our solution? So by getting feedback on risk mitigation accounting and on post-implementation review, we can identify if there are some areas of risk management that we didn't cover well. So that is one thing we can learn. Also, when we develop the proposal for disclosure for risk mitigation accounting, we lean heavily on the disclosure requirements in IFRS 7 that are already there. So to look at the feedback on how well the disclosure requirements in IFRS 7 work at the same time as we design the new disclosures would be very beneficial to us. If we learn something, we can apply this immediately for the risk mitigation accounting model. And one last thing that we also have to consider is about the withdrawal of IAS 39. As you know, it was always expected that we will need to withdraw IAS 39 at some point. The question that we ask our stakeholder to respond to is how well we can do this transition, in which way and what time would be best to withdraw IAS 39 and leave IFRS 9 together with this new model and IFRS 7. So it's not a matter of whether, because it's quite clear we will need to withdraw IAS 39, but it is how to do it and what is the best time to do it. So feedback on that would be very useful. So we will manage the ED consultation period in parallel to the work on the post-implementation review to make sure we connect all the dots together and learn the most from that feedback. So if we take a high-level look to consider the benefit of risk mitigation, risk management accounting, risk mitigation accounting, we need to consider it both from preparer's point of view and for user's point of view. If we don't identify sufficient benefit for both, it might be that we need to think again. But we do believe there are benefits in this project, and Rika already listed many of them, but just to collect all of it together. From preparer's point of view, we do believe that preparers could present more faithful representation of the risk mitigation that they do for open portfolios. They would have a better tool to do it now, so they will be able to present more faithful information. They will have closer alignment between the accounting and their actual activities, which is very difficult to achieve. We hope we've done it the best we can. It doesn't mean that we have full alignment, but I think we have closer alignment, which should probably produce good benefits for preparers because it really is close to what they actually do. They don't need to do a lot more special things in order to reflect their risk mitigation practices. In the current accounting for hedge accounting, we cannot include everything as hedged item. This model is much more wide. We can include more positions or more underlying items as hedge accounting in the underlying portfolio. That allows more than what we had before. So I think it takes us a bit closer even to what companies are really doing. And I think the best benefit here in total is that we will have outcomes in the financial statements that helps to tell the story of a company much better. Company can explain itself to their users, and users would benefit from understanding the story of risk mitigation activities of a company much better, which is obviously a benefit for both preparers and users. And if we jump to the user's point of view, we will see more transparency about risk mitigation management. So they will have better information. They would understand the information better. They would understand the drivers of that type of risk mitigation activity. They would understand how an entity protects the underlying risk much better than they do today. As Rika mentioned, today, many times investors are telling us they skip that part in the financial statement that talks about hedge because they don't really understand it fully. They trust sometimes information outside financial statement. We want to bring them home in a sense so they can have better information in the financial statements, and that this information would speak better with information outside financial statements. So it's also providing as a hook to connect information in financial statements with information provided outside financial statement, sometimes using non-GAAP measures. And in total, when we provide better transparency, we expect that we will provide better economic decision-making to users. So these are the expected benefits. And as you go through this process of thinking of our requirements, this is the goal. If we are getting close but not close enough, we need to understand that and why exactly. So the future of IAS 39, as I already mentioned, we are expecting to withdraw IAS 39. The reason is that it's no longer fit for purpose. We knew this. This is what we're working on to fill in that gap about portfolio hedge accounting. And what we need to know now from our stakeholders around the world is how to do it and what is the right timing to do it. We want to respect our stakeholders. We understand some changes would be required. It might need to take time. We need to understand what does it mean for them in order to design the transition in the best way possible. And last, before I turn it to Ziki, but definitely not least, very important, insurers. So when we designed this project, historically, we had a lot of involvement from the banking industry. Way back to the discussion papers, banking industry was very much involved. But definitely, this project is not a banking project. This project and this model is open for everyone that manage risk in this way. So it is definitely open for insurers. And I spoke with insurers as we were progressing in this project, and I heard different things. Some insurers said, hey, this is really interesting. Can I work with this? Some insurers said, actually, I don't think I need it. Our board is really eager to understand insurers' point of view, to see whether this project can provide some better tool for them to reflect the risk mitigation activities better than today. The board really understands that there were a lot of improvement or changes because of IFRS 17, as was mentioned before. And IFRS 17 did bring some good alignment in some areas of providing better mismatch, and there is some risk mitigation option there. But still, if there is some space and this project can help, Our board is open to understand why it can help, how it can help, can it provide better information to insurers in order for us to consider that feedback and see, do we need to make more adjustment to this model to make sure it works for those that really need it? So feedback from insurers is as essential as feedback from banks, from users, and all of our stakeholders. And this is really important for us. Also important for us is our field test. Field test that we've published together with the exposure draft is an opportunity for preparers to work with the requirements in a specific fact pattern. The reason we have field tests is this project is complex, and until you work with the details, you might not find out that some things are not working exactly as you expected. So we really want the evidence from field tests to learn what needs improvement, if it needs improvement. So it's really important for us that banks and insurers and others that think this model can work for them would participate in our field tests and give us real good evidence of their own practice, of what is working really well to tell us to keep, and what is needing improvement to tell us to think about how to improve things. And with that, I hand over to Ziki.
Thank you so much. So the plan is use the next 25 to 30 minutes to give you a quick overview about the proposals in the exposure draft. And as any proposals, I think I will start with the question, who can use this risk mitigation accounting? As Hagen mentioned, we developed this model with a lot of interactions with banks. But the model itself is not industry specific, so we don't want to specify only banking activities here. Instead, we come up with the 3 criteria. As long as you meet those criteria, you would be able to apply the model. So I would expect a lot of financial institutions and some corporates would be able to do that as well. Now, for risk mitigation accounting, similar to hedge accounting, it is a voluntary model. That means entities can choose whether to apply or not apply this model. And on the other hand, there were questions when the board were deliberating this point, there were questions asked whether we should make this model actually mandatory, given the model is aimed to better reflect how risk is managed and what's the effect of those risk management. Mandating those applications could have its benefits. But at the end, the board concluded that still keep this model as voluntary because of the complexity involved, but instead, for those entities that meet the criteria of those activities but somehow choose not to use the model, these entities would have to make some qualitative disclosures. I will touch on those later on. Next, if I may talk a bit about the elements about the risk mitigation accounting model. You probably have seen this diagram quite a lot if you're following the discussion at the Iasb. Basically, the idea is to have that risk mitigation strategy throughout the model. And that is because the purpose of the model is to reflect how risk is managed, how repricing risk is managed in the entity. The intention is not to change the risk management activities, but instead to reflect the effect of your activities. That's why sometimes people think the model actually have quite a bit of flexibility in order to reflect various ways entities could be managing their repricing risk. Starting from the left-hand side, the idea is to look at assets and liabilities that give rise to repricing risk on a net basis. Hence, we expect entities to look at their financial assets, financial liabilities, some eligible future transactions, as well as called amount deposits. We only list it because it's an important part when we speak to industry. But the idea is to consider all those positions and form this net repricing risk exposure, NRRE. This NRRE is no longer a position concept, but instead a risk concept. In that process, we acknowledge entities might use different risk metrics, different methods to convert a position into a repricing risk exposure. But that is fine. The model allows the entity to reflect that according to their risk management strategy. Once that risk exposure is identified, the treasury function or a central function within that entity would then assess those, compare that with their risk mandate and risk limits, and decide what derivatives they want to use in order to manage and mitigate that risk exposure. And those derivatives that are used for repricing risk management purpose are called designated derivatives in this model, and they are market-traded derivatives facing external counterparties. And the idea here is we acknowledge these derivatives could be traded very frequently, and that's the dynamic nature of the repricing risk management. Hence, instead of asking the entities to document everything up front, we would actually start with these designated derivatives, as these derivatives would give evidence about the extent the entity wants to manage the risk. Hence, we have this concept of risk mitigation objective, RMO, in the gray box. For those of you who are following the project, you would know we previously had a concept called risk mitigation intention. We later changed the name to objective instead, because intention sometimes could be misleading in the sense someone would ask, what do you mean by intention? Is that just an idea in your mind, or is that something more solid? So we actually changed it to be objective. But the essence of this is it's the extent of the risk to be mitigated. It's evidenced by your real action in the market, and it is based on your NRRE, and it will lead you to a residual risk that's within your risk limits. Here, the risk mitigation objective is again a risk concept, not necessarily a position concept, and we don't have the linkage between the risk mitigation objective directly back to the assets and liabilities in the underlying portfolios. And that is a very important step we made in order to make the accounting closer to risk managers. Reasons being, when we talk to risk managers, they don't tend to identify individual positions or percentage of positions in order to manage the risk. They look at the risk holistically. However, that brings a challenge in terms of the valuation and the measurement, because we cannot measure a risk directly. In order to do that, we borrow a similar concept to the hypothetical derivatives, if you're familiar with cash flow hedging, but we call this benchmark derivatives in this model, and they are the mathematical expedient, and they are used for measurement purpose, as well as providing the further evidence about how the risk mitigation objective is going to change from time to time. So these derivatives would represent the risk mitigation objective, and then you will have both the designated derivatives as well as the benchmark derivatives can be used for measurement purpose, which I'll touch on later. Documentation, there's a lot of details. I don't go through this here, but I think the important point is we front load a lot of requirements relating to documentation. The reason being we want to accommodate the dynamic nature of the risk management here. If you think about individual hedge accounting under IFRS 9, the requirement would be you having the documentation first and then you do the trades. But that would not be practical if you are doing those activities on a very dynamic and frequent basis. Hence, under this risk mitigation accounting model, we expect entities to do those documentations upfront, talk about the approaches you would apply, how would you react in different circumstances, and then we make sure you later use those methods to identify different elements. So it's important, but it's front-loaded to the beginning. Next part is probably the most frequently asked part of the model, the underlying portfolios or the eligible underlying portfolios. What can you include to the left-hand side of that diagram in terms of the risk you want to mitigate? The requirement is trying to cover as many positions the entities are managing for repricing risks. Sometimes people refer to this as their banking book, but we don't use those concepts here. It's the financial assets and the financial liabilities at amortized cost. On top of that, you also have those fair value through OCI assets, because from a performance reporting point of view, they are similar to amortized cost. You use the EIR method and you report financial income accordingly. We also include some future transactions, but the difference here is we allow entities to assess based on a portfolio. This is super important, especially for things like call demand deposit, where on an individual basis, they are contractually overnight, but we know entities like banks, they tend to have a portfolio view on those. They use different models trying to figure out behaviorally, customer won't withdraw all the balance overnight, despite the rate offered may not be market rate. So from a repricing risk management point of view, they tend to be more similar to a fixed rate exposure for a longer duration and will be risk managed accordingly. And the model, by allowing the assessment on a portfolio basis, would be able to achieve that as well. Another point is about a hedged exposure and the interaction between IFRS 9 hedge accounting as well as the RMA, risk mitigation accounting. And for that one, the board decided to allow a first-level hedge accounting to be included in the RMA as underlying portfolios, so that entity would be able to, for example, hedge a different type of risk first, and then put in the combined effect into the risk mitigation accounting. Just give you a flavor about the most frequently discussed use of this hedged exposure. That is, for example, for cross-currency hedging cases, where entities might raise finance in foreign currency and then use cross-currency swap to swap them back to their local currency. Now, in that process, the entity could do a first-level hedge using the foreign-denominated debt together with a cross-currency swap for FX risk first, and then the combined effect would likely to be similar to a local currency-denominated floating rate debt, and that can be included in the eligible underlying portfolio as well. So these are the proposals. One other thing to mention is probably the most discussed topic is whether equity instruments are in or out of the model. And that includes discussion about equity-like instruments like AT1, additional tier 1 instruments, where it has some sort of debt features, but for accounting reasons, due to its contractual provisions, they are accounted as equity. Now, Rika mentioned we actually issued a new webcast, webcast 3, so we talk about those. I would encourage you to listen to that as well. But in short, although the board decided equity instrument itself cannot be included because of the reasons listed in the boxes, we do think entities could still be able to reflect the way they manage equity. As they told us, they do equity modeling and they try to stabilize their net interest income by managing equity. If that's what they're doing, there are provisions in the exposure draft that will allow entity to do those. Coming to determine the net repricing risk exposure, that is the process of convert a underlying portfolio, the positions, into a risk exposure. In that process, the key principle is to allow entities to do that process consistent with how they do that for risk management purpose. So that's where sometimes people mention there is a bit of flexibility in the model. And that is required because if you think about the objective of the model is to better reflect how the risk is managed and the effect of that. So we want to, as much as possible, allow entity to translate their practice into accounting, into financial reporting. So the idea would be allow the entity to first identify these positions and then allocate them based on repricing time bands. Repricing time bands is another concept asked a lot from our outreach sessions, people sometimes ask, why do we need to have them? The reason is because consistently we were told that's how entities look at assets and liabilities with slightly different features holistically. And the reason to do that is to group and aggregate those positions so that you can manage them together. And in terms of the risk measures, in order to do that, we are basically flexible in the sense use whatever you use for your risk management purpose. It could be a fair value based measure like present value per basis point, PVBP or PV01, or it could be any other kind of a cash flow based measures like maturity gap analysis or some other analysis. We didn't specify what method can or cannot be used. The key principle, as I mentioned, is to be consistent. And the other thing is everything needs to be assessed against a mitigated rate. And that is the rate or the benchmark you use for your risk management in order to group different assets and liabilities together and manage them together. One common question is, can I group positions that benchmark to slightly different rate together? The short answer is yes, you can, if that's consistent with how you do for risk management. But the important thing here is, in order to manage an asset and a liability that's referenced to different benchmark, I think the first thing would be you have to identify which benchmark are you managing against, and that is this concept of mitigated rate here. Move on to the designated derivatives. These are, as I said, derivative traded with external counterparty, and because we are talking about repricing risk, we expect those to be interest rate derivatives. Other than that, we don't have a lot of restrictions. I mean, we have this provision about net return options as well as fair value change dominated by the underlying risk to the, not dominated by unrelated risk. That's not the mitigated rate. But I think these are just a common part of the requirement because you would use those derivatives for risk mitigation purpose in the first place. So I don't have too many points to mention on that one. Oops. Risk mitigation objective. As I mentioned, it's the amount of risk to be mitigated, and it is evidenced by the real action the entity took. And this is also the dynamic part of the model, which meant the RMO can be adjusted prospectively as frequently as needed by the entity. Prospectively is important here, as you cannot go back, because that would be using hindsight. But for going forward, we want to reflect how risk management reflect to the market or the change in the conditions, so that is not a problem. And the evidence through the actions is an important consideration here, because unless the entity actually trades something in the market, we want to avoid a thing that accounting and the risk management is reflecting different things, different stories, which could be the case in some circumstances, especially currently, because entity rely on things like proxy hedging under IAS 39, and that is not helpful because it's difficult for users to later decide the effect and do analysis accordingly. One other limitation here, and it's also the reason why we have this mitigation in the name, risk mitigation accounting, is because we don't want entity to mitigate more risk than what they have. Because to us, that is the accounting restriction to make sure entities don't use this accounting exception provided to the extent that that wouldn't provide useful information to the users. Hence, the amount of risk the entity can mitigate, hence the amount of risk would be in the benchmark derivatives, would be capped at the maximum possible amount you can mitigate, which is NRE for each of the time band. And then, as I mentioned, the benchmark derivatives, once they are created, they can be measured and tracked and used for further analysis internally if you want to see how your risk mitigation objective have changed over time. The key principle is to reflect the dynamic nature of your entity's risk mitigation activities. So we want to make sure there is no discrepancy as much as possible. Benchmark derivatives, they are similar to hypothetical derivatives. And to that extent, it's a mathematical construction based on the amount of risk you know, the mitigated rate you know, which would take an example of an interest rate swap. The mitigated rate would be the benchmark for your floating lag, and you would then calibrate the derivative based on the current market conditions in order to work out your fixed lag, the fixed rate, and you can then, based on the amount of risk, to decide the notional, so that you could create such a derivative that would represent your risk mitigation objective, but at the same time give you a position that you can later measure and use for accounting and reporting purposes. Coming to measurement, it's fairly similar to cash flow hedge mechanics with some twists. So starting from risk mitigation objective, as I mentioned, you build the benchmark derivatives. These are not recognized on your balance sheet, only used for measurement purpose. And on the other side, you have these designated derivatives. They are recognized on your balance sheet. They're real derivatives. You compare the change in the fair value for those two, and the part that's overlapping, i.e., sometimes we call it the lower of the two, you go to this risk mitigation adjustment. And if there's any ineffectiveness or misalignment, it's get reported in profit and loss immediately. So you might say that's quite similar to cash flow hedge. It is, but the significant difference here is the risk mitigation adjustment gets reported on balance sheet rather than OCI. There are a couple of reasons for that, both technical and practical, but the board actually made a departure to the existing conceptual framework on the basis of providing more useful information. This adjustment is, in essence, a valuation adjustment, doesn't necessarily meet the definition of assets and liability, but we want to make sure they are reported as a separate line so that the nature is clear to people. But if we step back and look at the whole picture, in effect, all what we are trying to do here is to provide an accounting exception for those derivatives as long as they are used for risk mitigation purpose, and we have those additional steps to prove they are doing that for this purpose. We then, instead of reporting the fair value change on those derivatives into P&L immediately, we take that out, park it as a risk mitigation adjustment, and release it over time into P&L. So it's a timing difference adjustment. To that extent, it's very similar to hedge accounting. But by doing that, we provide information that these derivatives are used to mitigate the fair value change of your underlying item or to mitigate the cash flow change in terms of the net interest income protection, hence the design of the measurement. In the interest of time, I won't talk too much about unexpected changes, but basically because the model is based on expected cash flows, as you would know, expectation may not always land as we hoped for in the first place. And when there are unexpected changes, we expect the entity to go back and adjust the benchmark derivatives in order to reflect the effect of those unexpected changes. An important concept here is we don't want to reflect all unexpected changes. It's a dynamic process, so it would be too much to do that. Where we want people to reflect is when you have an unexpected change that leads you to a situation where you over-mitigate yourself, i.e., I thought I might have 100 exposure to begin with. I mitigated 80 units of that 100, but later on I realized actually my actual exposure is not 100, it's actually 70. In that case, we expect people to go back and adjust for that extra 10, because the maximum you could be mitigating, you could have mitigated if you have the information now, would be 80. So I think that's the concept here. One practical consideration the board gave is many entities told us practically this going back and reflect is very complex because that would require them to track how their risk mitigation has evolved over time, which is a difficult process. Hence, we proposed a fallback option. If you were able to reflect the benchmark derivative perfectly, that's fine. But if you cannot, that's where this risk mitigation adjustment access comes in. So we allow them to adjust the benchmark derivative based on reasonable and supportable information as much as they could, but acknowledging that I didn't adjust them accurately meant coming to each of the external reporting date, the entity is required to first assess is there an indication that there could be a situation my risk mitigation adjustment still hanging on the balance sheet cannot be realized in full because I, for example, early recognized some of my fixed rate assets by selling them. If this is significant enough in volume, I think no one wanted that balance sheet item risk mitigation adjustment still hanging there because it would no longer provide any useful information to anyone. So it's a two-stage process. The concept is if you have an indication, then you do the measurement. If there's no indication, you don't even need to worry about the measurement. And the measurement is based on your present value of NRE. Instead of going backwards, trying to figure out how it changed over time, we just ask you to look at a snapshot view today, based on the position you have today, and assume you would have fully mitigated all the risk you have today. What would be the maximum adjustment that you could justify? And make sure whatever is your risk mitigation adjustment do not exceed that amount. That way, we provide assurance that at least I'm not recognizing what or more than what my balance sheet could support. It is not an accurate amount compared to what you go back and adjust everything, but I think it's important, it's a fallback option. Discontinuation is focusing on whether there's a change in entity's risk management strategy. Given it's a dynamic model, we actually don't want to see a lot of discontinuation. Hence, unless there is a significant change in your strategy, the model would consider a lot of movements on the right-hand side as a dynamic part of the model itself, hence continue the model prospectively and adjust accordingly. And in terms of the transition, we do understand entities have all sorts of different accounting reflection currently. They could be using hedge accounting, they could be using IAS 39 version of hedge accounting, IFRS 9 version of hedge accounting. They could be doing fair value option, where they designate assets and fair value through P&L to provide offset. So the idea is once the new model goes live, regardless where your starting point is, you would be able to move to the right-hand side, i.e. you either have IFRS 9 hedge accounting or you apply a risk mitigation accounting model prospectively from that point, and you will be required to have the relevant transition disclosure accordingly. And the last, presentation and disclosure. And in terms of presentation, as you can see, that bold line is the extra line. On top of your net interest income, you will also have this unwinding from risk mitigation adjustment, i.e. you park the adjustment there, and this is the part that gradually you recognize that in P&L. And in the balance sheet, you will have an extra line called risk mitigation adjustment as a debit or credit. I think it might be easier to look at this slide, where it gives you a flavor using a bank as an example, how it will look like. So on the left-hand side, you have your fair value through P&L assets, amortized cost assets, so on and so forth, and you will have this green line, additional line, RMA adjustment. And on the right-hand side, internal P&L, before the net interest income, you can clearly see this effect of risk management, risk mitigation accounting as a separate line as well. In this case, because it's a debit balance, it's actually a bleeding into P&L to the extent that in this example, the risk mitigation actually stabilized the NRI by reducing the net NRI. But that's the purpose of this derivative we traded. And coming to disclosure, there were a lot of discussions between the usefulness of the information and the potential commercial sensitivity, given a lot of disclosure potentially could tap into risk management territory, and we want to avoid that because it's an accounting disclosure. So we developed the disclosure based on the existing IFRS 7 hedge accounting requirements. That's why the interaction with the PI of hedge accounting is very important, and we do encourage you to think them in the context of each other. And just to highlight 2 or 3 disclosures that in our view could be very useful. First is about the derivatives, and we expect entity to show them in the maturity analysis so that analysts can see their notional amount and a fixed rate by time buckets. And the second one is the sensitivity analysis, that is before the entity does any risk mitigation activities with derivatives, what would be their organic position look like in terms of sensitivity, so that people can realize to what extent the entity used derivative to achieve its performance and the net interest income at the moment. And then lastly, for anything that's in the risk mitigation adjustment, we want entity to disclose, assume the market stays where it was at the reporting date, how that adjustment is going to be unwound back into P&L by time buckets, so that this can be analyzed in addition to the analysis on the underlying portfolios to give an overall picture of the expected NII and the net interest margin in the future. So lastly, it's for those entities that's applying the risk mitigation, applying the activities as we described, but not apply the risk mitigation accounting. We want them to show these qualitative explanations. We don't expect them to be super detailed. The purpose is to provide a hook or a starting point if the analysts are interested and want to ask questions about those. So I guess that's what I want to cover in terms of presentation. Hopefully we're doing all right timing-wise, but thank you for your time.
네, 발표 잘 들었습니다. 감사합니다. 이상으로 주제 발표를 마치고 이어서 Q&A 세션을 진행하겠습니다. 진행을 위해 잠시 장례 정리가 있겠습니다. 좌장께서는 무대 위로 올라와 주시기 바랍니다. 네, Q&A 세션은 좌장이신 회계기준원 박정혁 연구위원께서 진행해 주시겠습니다. 위원님, 진행을 부탁드립니다.
네, 안녕하십니까. 오늘 귀중한 발표를 해주신 Iasb 2분의 보드 멤버와 또 테크니컬 스텝인 지키 분께 먼저 감사의 말씀을 드리겠습니다. 회계 보드위원님은 지난해에도 IFRS 18 아울리치 활동에 와셔서 한국에서 이렇게 또 발표를 해주셔서 여기 계신 분들이 많이 굉장히 이제 익숙하실 것 같습니다. 옆에 제 바로 옆에 계신 리카 일본에서 보드 멤버시고요. 저 여러 가지 프로젝트를 한국과 많이 도와주셔서 대단히 감사하고 또 이렇게 서울까지 와주셔서 감사하고 지키는 저랑 몇 번 런던에서 2-3번 회의 테크니컬 세션을 좀 가졌었죠. 저희가 이 다이내믹 리스크 매니지먼트라는 명칭으로 이 프로젝트가 진행이 될 때 그 한국회계기준원에서도 많은 관심을 가지고 있었습니다. 근데 지금 오늘 발표하는 내용을 들어보면서 내용이 굉장히 이제 좀 많이 정교해졌고 또 굉장히 실무의 어떤 어려움들을 반영하려고 하는 노력을 많이 하셨다라고 생각을 하고 제가 2년 전에 뭐 이렇게 이야기할 때 보면 굉장히 유럽 쪽의 뱅킹의 인더스트리의 프랙티스를 가지고 만들고 그래서 우리 한국이나 아시아 쪽에 과연 이게 적용 가능할까라는 고민을 많이 했었는데요. 오늘 이제 발표를 듣고 나서 저희가 생각하는 부분들 또 자료를 미리 주셔서 저희들이 이해관계자 분들과 여러 가지 이야기를 많이 했는데 거기 나온 부분들을 가지고 오늘 좀 토론을 진행해 보고자 합니다. 오늘 사실은 큰 이제 발표가 있었지만 오후 세션에 은행, 보험 또 회계법인으로 나눠서 디테일한 토론 세션들이 진행이 됩니다. 그래서 오늘 이 현장에서는 좀 이 철학적인 이 모델과 또 그런 부분들이 가장 어려우신 질문이 될 것 같은데 또 그 다음에 큰 선에서 여러 가지 궁금하실 수 있는 분들을 가지고 질문을 드리도록 하겠습니다. 저희가 뭐 굉장히 많은 질문을 받았는데 오늘은 시간 관계상 11시 30분에 만료를 해야 되니까 제가 한 몇 가지, 4-5가지 질문을 좀 준비를 해왔고요. 거기에 대해서 질문을 드리도록 하겠습니다. 먼저 좀 가장 브로드하게 개념적인 부분들은 나중에 회계법인들과 많은 이야기가 있겠지만 저희가 궁금한 부분들이 이 지점인 것 같습니다. 지금 ISB가 제안하는 모형은 금리가 리프라이싱 되는 리스크에 대해서 타겟팅을 하고 계시고요. 그래서 특히 이제 순액으로 위험을 관리하는 경우에 그 위험 관리 활동을 재무제표에 더 충실하게 반영하겠다, 이런 의도를 가지고 있는 걸로 이해를 하고 있습니다. 그런데 은행도 마찬가지고요. 한국의 특히 보험업권 같은 그 금융회사들은 사실은 이 자산과 부채의 ALM 관점으로 관리를 하지만 특히 실무적으로 보면은 자산에 대해서 언어더 파생을 통해서 자산에 대한 해칭을 통해서 보험사의 경우 듀레이션 갭을 줄인다든지 여러 가지 이자 마진을 줄이는 그런 노력을 하고 있거든요. 그래서 이런 그 자산 중심의 ALM을 구조를 가지고 있는 한국이라든지 이런 금융기관들의 경우에 이 사실은 순액 기준의 관리 프랙티스, 예를 들어서 뭐 타임 밴드라든지 미티게이티드 리스크 레이츠라든지 이런 부분들 구체적으로 저희가 정의를 하지 않고 총액으로 관리하는 이런 경우에 과연 이 RMA 모형이 제대로 워킹할 수 있다고 보시는지, 만약에 순액 베이스의 ISB가 정의하고 있는 이 적용 요건들이 맞지 않는 경우에도 어떻게 이 한국 금융권들의 그 해칭 관행이 적용될 수 있다고 하는지 먼저 첫 질문을 드리고 싶습니다. 누가 대답을 해 주실까요? 네.
Yeah, I can start. Thank you very much, Jay. I can start, and maybe Ziki or Rika would like to add more comments. I think, first of all, it's our obligation to learn the practices in Korea, in other places, and to see how much they align to what we've heard. We've heard on many different risk mitigation activities. Sometimes they are called ALM and they seem to fit. Sometimes they are called A&M and it's not quite clear whether they fit. I think our project is, when we say net, we don't think about assets and liabilities per se, we think about net exposure. So you don't hedge a particular item or a group of items that are similar, you hedge a position, an exposure. And I've heard so far of ALM techniques that are looking at this in this way, and the model should work for them. But I think for us it's really important to understand that practices in different countries, including in Korea, to see if it fits, and if it's not, why. Maybe it's the wording we haven't been clear, or maybe we didn't fully appreciate the methodology used. So I think our model is quite flexible, does not require you to have a specific number of groups or anything like that. So it should accompany a lot of practices that are looking at net exposure, but it is our obligation to learn. If you have anything to add.
No, I think that's absolutely right. And also, just to mention, the reason we focus on repricing risk is because we were told that entities don't necessarily look at just the fair value or cash flow. They try to match the repricing of their assets and liabilities, and that's sometimes driving their decision making. Whether that is the case, we want to understand, but based on the initial feedback, I think it's important to distinguish this sort of activities versus the other type of activity where you have a fixed rate asset and you are worried about fair value of that, not necessarily trying to link it with a liability that's floating rate. And in that case, we think the existing IFRS 9 hedge accounting could provide the answer already. So we want this model to work in addition to what's already available. I mean, as Hage said, we can discuss the details in later sessions, but here is the high-level kind of background.
I just want to add to Hagit and Ziki. I think you might feel like you're on the journey of learning our new model. But at the same time, we are also on a learning journey with you to understand how you manage repricing risk or other risk in your environment. We understand that each jurisdiction has a different practice about how you manage risk mitigation. And we really want to understand, because I think our model is try to better reflect how you manage your risk internally. So I think even though we are talking about focusing at external derivative transactions, but at the same time, we want to understand how you do within your company. Thank you.
네, 제가 이게 런던에 가서 이렇게 유럽의 뱅킹이나 보험사들을 이렇게 만나 보면은 그쪽에서 사실 관리하고 있는 위험 관리 이 프랙티스랑 좀 많이 다른 면이 있는데요. 방금 지키 스텝께서 연구위원께서 굉장히 이 모델 자체가 플렉서블해서 대단히 다양한 어떤 리스크 관리 산업별 그런 모형들을 반영할 수 있을 것이다라고 이야기를 하셨는데, 이제 플렉서블하다라고 하는 거에 대한 포인트가 뭐냐면 비교 가능성에 대한 이슈가 있을 수 있다고 생각합니다. 그러니까 미티게이티드 레이스를 정하고 타임 밴드별로 또 서브 그룹이라는, 사실 이게 결국은 회계 어카운팅 유닛에 대한 이게 고민을 해야 되는 거고요. 이 어카운팅 유닛에 대한 정의가 제가 볼 때는 좀 이게 공개초안에서 명확히 언급되어 있지 않아서 이 어카운팅 유닛이 다르게 되면 기업들의 손익이 달라지는 효과가 있을 것이고, 그래서 그런 부분들에서 현재 공개초안에 오늘 발표 내용에는 없는 것 같은데요. 어떤 비교 가능성 관점에서 어떻게 어카운팅 유닛에 대해서 보고 계신지, 사실은 기업들이 굉장히 다르게 유닛을 설정하면 손익이 달라질 수 있다라는 컨선에서 질문을 좀 드리겠습니다.
So I think comparability is very important, but it's by no means meaning uniformity. We expect that comparability would give you, as a user of financial statements, the opportunity to compare. But if the underlying practices or positions are different, it's actually good to see different things. So this is why the disclosure requirements, together with the rigor around this model, and there is, so when we say flexibility is not to do what you like, there is some rigor in this model, should allow that comparability by showing how companies differently use derivatives to manage the risk, but together with the rigor of the requirements and another layer of disclosures, we expect to achieve that comparability. So I don't think we ignore that aspect. Actually, it's a very important aspect, but we achieve it by developing the requirements to fit what companies are doing. And if the outcome is different, that's the story. It's a different story.
특히 이 RMA 모형 자체가 제가 굉장히 좀 이게 충격적으로 받아들인 부분이 옵셔널 발런터리 베이시스로 적용을 하게 되어 있거든요. 그러면은 이 RMA 모형을 적용하는 회사와 적용하지 않는 회사, 특히 더 나아가서 본다면 IFRS에서는 이 RMA 모형이 있고 USGAAP에는 아직 우리 IASB가 가지고 있는 오픈 포트폴리오 매크로 헤지 개념이 있으니까 아직 USGAAP을 쓰는 회사와 이 IFRS 쓰는 회사에 대한 비교 가능성도 좀 고민이 있지 않을까라는 생각에서 두 가지. 첫 번째, 기업한테 이 모형을 옵셔널로 준 이유하고 USGAAP과의 정합성 문제, 이 두 가지 질문을 드리겠습니다.
I think what we want to achieve within this project is, firstly, we want to bring companies a company story about how to manage risk mitigation accounting within the financial statement to show the effect within the financial statement. That is a kind of the foundation But at the same time, when thinking about our relationship with other accounting requirements within our standards or different accounting standards, we understand some companies still want to apply IFRS 9's general hedge continuously. So I think this is really the most important thing is what's the best way for you to explain your story about risk mitigation activities or other related activities within the financial statement. So when thinking about IFRS 9 general hedge requirement, which is also optional, so I think optional use can allow the company to provide more useful for information for users and their communication with investors to explain about their own story. So we really don't want to restrict the company to apply only one mechanism. We just allow them to think about what is the best way for them to tell their story.
I can add one point. I think that in the past we have considered whether we need to do this mandatory, but the thing is if we were to do this mandatory, we would need to design the entire model a bit more strict, and then it would be applicable to maybe even a smaller group of companies, and they would not fit in, and we didn't want that outcome. It was very important for us that this model would be accessible. And then another point in terms of comparability, you would notice that Ziki mentioned in his presentation really at the end that even if companies have risk mitigation activities that are in the scope of this requirement, but they choose not to apply our risk mitigation accounting, they would be required to provide some disclosures. So even those that would not choose this option would provide some disclosure that will help with comparability. In practical terms, I suggest that even if you don't think that this option is interesting for you, please be careful to look at the scope, because if you meet the scope requirements, you will need to provide those disclosures. So also important to respond to this, even if you don't think, I don't want to invest in this in the moment, just take the time to think about that as well.
역시 IFRS가 글로벌 기준이다 보니까 뭐 다양한 나라의 프랙티스 또 대형사, 중소형사 모두를 다 관할하는 기준을 만들기가 굉장히 어려운 IASB 보드 멤버들 관점에서 가장 큰 컨선인 것 같습니다. 저희가 이게 전체적인 이 오버롤한 지금 Q&A를 나누는데요. 지금까지 일반적인 모형에 대해서 이야기를 했고 디테일한 부분들 제가 접수를 받아보니까 회계법인 분들께서는 개념 체계적인 문제들 이런 이론적인 문제들에 관심이 많은데요. 그런 부분들은 추후에 별도 세션을 진행하기로 하고요. 일단 보험업계에서 관심이 있는 몇 가지 질문들을 좀 드려보고자 합니다. 이 사실은 보험회사들한테는 IFRS 9의 캐시플로우 해치라든지 39호의 오픈 포트폴리오 해치의 경우는 말씀하셨듯이 굉장히 극단적인 1:1 대응이라든지 문서화라든지 굉장히 어려운 요건 때문에 실제로 보험회사들이 이 전사적으로 ALM 관리를 하고 있음에도 불구하고 사실은 못 썼었거든요. 그래서 대부분 사실은 뭐 굉장히 힘든 상황이 있었는데 그래서 이 프로젝트에 대해서 굉장히 관심이 많았던 걸로 알고 있습니다. 근데 아시다시피 이 IFRS 9의 일부 개정으로 이 프로젝트가 진행이 되고 있고요. IFRS 17은 23년부터 시행을 되고 있죠. 근데 이제 17의 모형은 금리 리스크가 매년 재측정되는 모형입니다. 거기다가 또 CSM이라고 하는 부분에도 일부 금리 리스크의 변동이 들어가 있고요. 그래서 그런 관점에서 이렇게 본다면 지금 9의 어떤 일부 개정으로 진행되는 이 RMA 모형이 보험사에 실제로 적용되기 위해서는 사실은 그 IFRS 17의 어떤 일부 개정이 필요한 것이 아닌가라는 뷰도 한국에는 존재합니다. 왜냐하면 보험사들은 사실은 이 은행과 같은 리니어한 리스크 파생 상품보다는 실제로 최저 보증 리스크, 즉 옵션을 많이 활용하는 그런 designated derivative를 구성을 될 거거든요. 근데 아시다시피 벤치마크 derivative에는 사실은 fair value의 최초의 제로라는 요건, 그 다음에 linear 예, derivative가 들어가야 된다는 여러 가지 요건들로 보면 제가 볼 때는 과연 이 모형이 나온더라도 보험사가 적용하면 오히려 큰 변동성, 베이시스 리스크를 포함해서 생길 것 같다는 우려가 사실은 많이 있는 것 같습니다. 그래서 이 유럽 보험업계에서 과연 이 모형에 대해서 어떻게 지금 이야기를 하고 있는지 가장 궁금하고요. 그 다음에 이 RMA 모형과 관련해서 향후에 이 코멘트 피어리어가 끝나고 ISB가 이렇게 전체적인 리뷰를 하는 과정에서 17에 대한 어떤 만약에 요구가 있다면 PIR이 뭐 내년쯤에는 시작이 될 텐데 거기에 어떤 반영할 계획이 있으신지 그런 거를 좀 듣고 싶습니다.
I will start. So I think you've asked generally two questions, the reactions in Europe and then the openness to deal with 17, right? So I think in terms of the reactions, until we published the exposure draft, we reached out to insurance companies because we started to hear more interest. And we reached out in different places. And in Europe, actually, I've heard diversified views. Some companies said, actually, IFRS 17 helped me a lot. In the VFA model, I have this risk mitigation option there, and I can use it, and I don't use any other derivatives that much, so it is good that you do that, but at the moment, we don't see a need. Some have said the same, but they said, you know, because of IFRS 17, we are still thinking of how to improve our ALM. Currently, it might be more focus on the solvency requirements. Maybe we will change. So please keep us in your mind as well, because we might need this in the future. So we've heard that. And we've heard from others very specifically. They say, yes, it can work for us. For example, the one that I've heard on a call that I was a company that used OCI. And they said that they use OCI for some of their insurance liabilities, and if they hedge this using derivatives, the movement in the derivatives hits P&L, and on the liability goes to OCI, and that's not what they would have expected. So there is a range, but I think, and I've shared with you before, this is our first engagement, real engagement after the ED is out. We have not heard more since then, so you are one of the first, and we will hear more as we go in the process. And in terms of 17, I think it's a bit early to speak about 17. We need to think about, we have a few moving pieces. So we have this RMA, ED, we have IFRS 9 PIR, where if insurers do not think IFRS 9 gives them good solution, we want to hear that as well. And of course, 17 will come to be a discussion, and it will be my pleasure to discuss this as well.
I might want to add one thing. So within the exposure draft, we have a separate question for insurers. And we want to understand whether this model itself works for insurers. If not, we also invite insurers to think about alternative approach. We truly appreciate if you can come up with some other idea that might be more helpful for you to communicate with investors. That we want to know. Thank you.
오후에 이제 보험업계 세션에서 더 깊은 논의가 있을 거라고 생각이 듭니다만은 이제 17에서 OCI 옵션이라든지 또 이게 회계 모형, 일반 모형이나 Variable View Approach 모형의 선택이 있는데 만약에 RMA 모형이 들어왔을 때 한번 다시 개정을 통해서 그런 것들이 바뀔 수 있는 여지가 있는지 그런 것에도 관심이 있을 수 있겠다라는 생각을 해봤고요. 시간 관계상 마지막으로 저희가 질문 드리고 싶은 게 이 발표에도 있었습니다만은 필드 테스트, 필드 워크에 대해서 많은 참여를 말씀을 해주셨는데 우리 그 IFRS 17 강의에도 IFRS 17 필드 테스트를 2차례나 ISB가 했었죠. 그때는 사실은 그 참여자 회사의 수를 ISB가 제한을 하셨습니다. 그래서 15개 보험사로 선정을 하셨고 그 선발하는 과정도 있었는데 요번에 필드 테스트, 필드 워크는 구체적으로 어떤 그 참여자라든지 그런 거에 제한이 있는지 그런 걸 좀 간단하게 마지막으로 소개해 주셨으면 감사하겠습니다.
I can answer really quickly. No limitation. As many as possible is welcome. This is a very complex area of accounting. We want real evidence and experience. And also we are at your service if you encounter difficulties in application. I volunteer, Ziki, to help everyone with any question that comes up. There is no limitation. We really want you to participate. Thank you.
네, 오늘 이런 보드 멤버님의 말씀을 듣고 아마 많은 회사들이 또 필드 워크에 대해서 관심을 가지고 참여해 주셨으면 이게 더 좋은 우리 한국에 더 맞는 이런 모형이 개발될 거라고 기대를 하면서 오늘 Q&A 세션을 이것으로 마치도록 하겠습니다. 감사합니다.
네, 박정혁 의원님 감사합니다. 이번 Q&A 세션을 통해서 위험경감회계에 대한 국내 이해관계자들의 높은 관심을 확인하였고 미래에 나아갈 방향에 대해서도 의미 있는 논의가 이루어진 뜻깊은 시간이었던 것 같습니다. 이상으로 오늘 세미나를 마치겠습니다. 오늘 이 자리를 빛내주신 발표자님, 좌장님께 각별한 감사의 말씀드립니다. 아울러 바쁘신 와중에도 시간을 내셔서 세미나에 참여해 주신 모든 분들께 감사드립니다. 앞으로도 저희 회계기준원 세미나에 변함없는 성원을 보내주시길 부탁드립니다. 감사합니다.